Hello everyone, this is Jay and welcome to the second video of this channel. So in this video we will discuss the CPI that was released this morning, and the number came out really bad, right? At a 0.4% more than last month, and it rose actually 8.2% over the last 12 months. So 0.1% more than expectations. And of course, when that happened, the markets really reacted poorly. But the first question is, why do we care about the CPI? Well, we care about the CPI right now, and we've cared about that for the past 11 months because the Fed has a mandate to keep inflation at a 2% target. That is their mandate. And when the CPI is at 8.2%, the Fed is not meeting its target. So they will keep raising interest rates. They have to keep raising interest rates in order to get back to the 2% target. Because when you raise interest rates, economic growth slows, which means that people are out of work, people spend less money, and if they spend less money, you solve the demand problem. You have less demand and prices go down. That is the rationale behind that. And they have to do this very carefully because unemployment has to stay low. The unemployment is their other target, their other mandate is to have low unemployment. It has to stay low. So they're kind of in a tough situation where they have to balance both unemployment and inflation. So this morning, of course, all of the innovative stocks, all of the stocks that have actually a chance at keeping up with the rate of monetary growth, that have high growth rates, maybe not Carvana, but definitely Coinbase, Etsy, etc. These companies, they were all crashing. All of the speculative stocks were down today quite a bit. Tesla, for example, Google, all of these companies. And then a few minutes later this morning, about 10 minutes after the opening, there is a statement from the White House. And that statement claims, and I'll read here, inflation over the last 3 months has averaged 2% at annualized rate. And the White House is talking about inflation and how it views inflation. And of course, the White House views inflation at 2%. Which is exactly what the Fed wants it at. So when the market saw this, the market reacted positively quite a bit. And you can see that ever since the low of this morning, we've gained back 4%, almost 5%. So the market really follows the Fed much more than anything right now, much more than growth, much more than earnings, much more than innovation. And that's a problem because we have such a short-term horizon, and all of the innovative companies have been crashing, even though they have high growth rates. So let's go back to that. Will the Fed keep raising interest rates? Their current interest rate is 3.25%. We've had a few 75% rate hikes that were really, really tough in the economy. They've actually increased the rate more than tenfolds already. And the forecast for the end of the year is between 4.5 to 5%. Which is a tremendous rate hike. And the Fed, of course, could keep raising interest rates. And the more it raises interest rate, the more it will create a crisis. And the more you have a crisis, the more the CPI, in theory, will come down. But there is a problem when you raise interest rates. And that problem is that things are starting to break, especially in the bond market. And the bond market is part of this conversation here. Why is it a problem for the bond market to Fed rates, to raise rates? Well, for example, there's fewer bidders for bonds because now you can have CDs, you can have savings accounts for regular savers. So fewer people buy bonds. Then you have a lot of leveraged bondholders, right? Who went on leverage, went on debt to buy bonds. And of course, when interest rates go up, what happens to bond prices? They go down. And so a lot of bondholders got liquidated and led to a forced sell. Right? There's fewer purchases of treasuries from the Fed. The Fed is doing quantitative tightening. The Fed is one of the top buyers of treasuries. When they do quantitative tightening, they at least buy less treasuries than they have in the past. And then lastly, you have countries like China or Japan who have been selling US bonds, Japan especially, to stabilize its currency as the US dollar goes up. So all of these people are selling bonds, and that is causing some problem, which is why the Fed may not be able to keep raising rates for so long, because otherwise we are going to have a financial crisis. So this was yesterday. Yellen worries over the loss of adequate liquidity in treasury market. Well, yes, fewer people are bidding on treasuries. That is a major problem. Let's look at what happened to the UK 2 weeks ago. 2 weeks ago in the UK, there were not enough bidders for the UK gilts, which is the UK bond. So the Bank of England had to intervene. Could something like that happen in the US, where the Fed has to intervene because there is no bidder for these bonds, or because there are too many sellers of bonds? A news today. The cost of living adjustment of Social Security, it's the highest ever, 8.7%. Well, that's very good if you're on Social Security, but what we see is that this historic rise, right, will push the trust fund at least to be out of money at least 1 year earlier than it would have. So what if inflation stays high? So what if we do a 9% COLA increase every year, where we are going to deplete Social Security faster than we thought, and that will most likely add some more selling pressure to the bond market. So there is problems with raising rates. You can't really raise rates that high that fast. It has to be a slow process. So the Fed would really like inflation to come down so that it can stop raising rates. And the Fed has to raise rates because the Fed knows that they may have to get back into quantitative easing sooner than they think, right? Because the government has a deficit. It's a famous deficit. We've had it for more than a decade. But the deficit is likely to be very, very high in the next fiscal year. Why? Stocks are going down as a result of interest rates going up, right? The cost of money is rising, and thus in your discounted cash flow, the stock prices go down. So a lot of people are selling stocks, creating losses, and as a result of that, they are lowering their tax bill. Bond prices are falling. Same thing. You may be creating losses in your bonds. Real estate. Capital gains on real estate will be much lower because real estate started to fall. And then lastly, we are in a bit of an economic recession right now, which means lower wages, rise in unemployment. We've seen a lot of very large tech companies announce a lot of layoffs. So all of this will lead to lower revenues. And that is despite the fact that the government keeps spending money on so many different programs. The Inflation Reduction Act, for example, is the latest example of that. So there is a problem. Less income from the government in the form of taxes, and higher spending in the form of student loan forgiveness, Inflation Reduction Act, and so on and so on. So what will happen? Well, what will happen is what has always happened, which is the debt will keep rising. We are at $31 trillion of debt, but I think that the better number here is $247,000 of debt per taxpayer. Do we really, really think that this debt can ever be repaid? Have the people who have saved cash from the 1990s, when raised really started, when the debt really started going up, have those people been made whole, right? Well, no, because there's so much more money that has been printed, and this money has been promised that it would be repaid, but it's never going to be repaid. The governments do not intend to repay that debt. As a result of that, your dollars that you held in the 90s, in the 2000s, as a share of the total money stock, you now have a smaller share of the money stock. And that is something that we really, really need to be aware about. And that debt will keep increasing because every year there is a deficit, the debt grows. And who is one of the top buyers of this debt, especially when everybody else is selling bonds? That is the Fed. So the Fed may have to go out into quantitative easing, or at least not raise rates as much as they have. So the Fed is in a catch-22. And this catch-22 is really due to the fact of today's inflation. Historically, people like Milton Friedman have said, inflation is primarily a monetary phenomenon. Well, that's because the definition of inflation back then was monetary inflation. Today's inflation is driven by supply chain issues and the energy crisis. That's what it's driven by, right? Technology, productivity is so high that prices should go down. in modern day, but not right now, because we've had all of these shocks, and most companies were operating in a just-in-time manufacturing process where they haven't been able to catch up. So we've had this shock of inflation, which I believe is mostly because of supply issues. Yet the Fed has no impact on supply issues; they can only have an impact on demand. They have to create an economic crisis. But it can't be too big of a crisis, because if it were too big of a crisis, it will crash the financial system, which is why I think they will start quantitative easing again. They will start printing again. But what could be another solution? Well, the other solution would be to make the CPI look better. That way, you can save face, lower your rates, and display a CPI that is going to be more palatable to your people and to politicians and to most of the financial systems, which is indexed on the CPI, raises, social security. And so, how do you do that? Well, let's look at the CPI. If you read the CPI today, in January 2023, there will be an update as to how the CPI is calculated. And this is something that has been done over and over and over, updating the way the CPI is calculated in order to not make it look this high. That's why we talk about inflation today and not necessarily monetary inflation. But let's go back to when CPI had a different methodology, like in the 90s, for example. The methodology employed in the 90s, if we were to use this methodology, we would see that current day inflation is actually about 17%. It is not 8%. It is about 17%. And so they can change the way CPI is calculated again. And that can help the Fed save face, help the Fed say, I took inflation down. And so that is coming up too. This change in the CPI weights are coming up shortly. So that is why I believe the Fed will pivot. They have to pivot. They have to start quantitative easing again. Thank you so much for watching my second video. I will get better at this. This is a learning curve. But thank you for your time. Don't forget to like and subscribe. Thanks for watching.